And from this video, I'm discussing ratios from 2019 to 2023, 5 hours papers and 5 ratio questions. So let's see first one, 2019 Taylor ratio. So here, the information given sales revenue, profit for the year, income tax, and the interest expenses. And further, the ordinary share capital value is given 4,200, and the total number of shares issued is given 150,000, and the total assets given 8,400. And here it says total assets and retained earnings as at opening date were 6,600,000 and 1,200,000 respectively, and assume that the liabilities of the company as on 31st March 2019 consisted only of long-term loans. And then they asking calculate the following ratios: net profit, interest cover ratio, return on equity, earnings per share, and debt to equity ratio, right? So to find out net profit ratio, net profit divided by sales into 100%. So here, the profit for the year is given 600, and the sales given 9 million. So 600 divided by 9 million into 100%. So your net profit ratio is 6.6s, or otherwise it can be present as 7%. And then interest coverage ratio. So when you're finding the interest coverage ratio, you have to add tax and interest to the net profit. So your profit given here 600, and the income tax and interest expenses given 40 and 80, and then you have to divide by 8. So your interest coverage ratio is 9 times. So from the interest coverage ratio, we are finding how many times that you can pay the interest from your profit, right? And then the third one, return on equity. So return on equity, to find out that profit divided by equity into 100%. So here again, you have to consider the net profit. So your net profit is 600, and the equity. So the equity is not given here directly. So you have to find out equity. So how to find out equity? So equity meaning total assets minus total liabilities. So here, ordinary share capital as a closing date is 4,200, and yes, and the total assets here given 8,400. And here, the retained earnings as at opening date is given 1,200. So 1,200 plus this year profit. So the retained earnings as at closing date is 1,800. Now you can find out the equity. So equity meaning stated capital plus reserves. So your stated capital as at opening date 4,200, and it's remained unchanged as at closing date as well. So your stated capital as at closing date is also 4,200, and the retained earnings as at closing date is 1,800. So the total of stated capital and retained earnings, your equity is as at closing date 6,000. So return on equity, profit divided by equity into 100%. So your profit is 600 and equity is 6,000. So 600 divided by 6,000 into 100%. So your return on equity is 10%. And then they ask to find out earnings per share. So how to find earnings per share? Here the profit is 600. You have to divide this profit by number of shares. So here the number of shares is given here 150. So profit 600, 600 divided by 150. Earnings per share is 4 per share. And then they ask in the debt to equity ratio. So debt to equity ratio means debt capital divided by equity capital. So equity capital as at closing date we found here 6,000, and debt capital. So the case is you have to find a debt capital. So as at closing date, the total assets and the share capital is given here. And as at no, here the closing, yes, here these are the given as at closing date. And here from 8,400, we found already the equity capital as at closing date 6,000. So 8,400 minus 6,000 is your debt capital, because it says the liabilities as at closing date is consisted only of long-term loans. So your total assets as at closing date is 8,400. From that, you have to minus the debt capital. So your debt capital, sorry, you have to minus the equity capital. Sorry. So the total assets 8,400. From that, you have to minus the equity capital. So which means your debt capital is 2,400. So how to find the debt to equity ratio? Debt capital 2,400, you have to divide it by equity capital. So your debt to equity ratio is 40% or 0.4. So which means when the owners invested to the business 1, you are getting loan 0.4, right? So I think yes, that's it for 2000. Yes, this is my post. So I'm doing others individual classes. So within Colombo area, 5,000 per visit, and I will do. I'm doing 3 hours per class. So you can arrange individual classes or small group classes, maximum two or maximum three you share. So further information, give me a call. So let's discuss. Okay. So please do share someone looking for individual class for A-level accounting in either English medium or single video. Okay, just give me a call. Thank you. So 2020 A-level question. Yeah, this is the simplest one comparing from 2019 to 2023. So here, these informations is given alpha, beta, and gamma, the three different companies, and the ratios given current, quick assets, inventory turnover, debtor turnover, debt to equity, and return to on total assets. So here they are asking the highest leverage company, highest efficiency in the inventory usage, highest liquidity, highest return on investment, and highest efficiency in collecting cash from the customers. So we have to pick the correct relevant ratios uh, when you are answering for these questions. So highest leverage, you have to concern debt to equity ratio. So based on debt to equity ratio, the highest leverage is company beta. For to find out highest efficiency in inventories, you have to concern inventory turnover ratio. So the highest inventory turnover has alpha PLC. So which means the highest efficiency in inventories is comparing these three is alpha PLC. For highest liquidity, you have to consider current or quick ratios. So based on current or quick ratios, comparing these three, the highest liquidity has in beta PLC. Highest return on investment, you have to consider return on equity. So comparing these three, return on equity is highest in gamma PLC. And the last one, highest efficiency in collecting from debtors. So you have to consider debtors turnover. So the highest return turnover has beta PLC. So the answer is beta PLC. That's it for 2020 and then 2021 past paper question. So this is 2021 error past paper questions regarding ratios. So this is bit tough one comparing the other years. So these information is given and then they ask in these ratios. So first one you have to find out net profit ratio. So to find out net profit ratio, you have to find out profits and sales. So here the gross profit given, from that gross profit you have to minus operating expenses, interest and tax expenses. So your net profit is 9,000. And the sales, here it's given in the additional information, the gross profit ratio of the company is 25%. So the gross profit is given 30,000. So comparing that, getting that gross profit and the gross profit ratio, then you can find out sales. Why? So the gross profit ratio meaning the gross profit based on sales. So if the gross profit is 25%, so your sales was 100%, right? So 30,000 is equal to 25%. So sales is equal to 100%. So your sales is 120,000. So net profit ratio 9,000 divided by 120,000 into 100%. So your net profit ratio is 7.5%. And to find out quick assets ratio, you have to find out first quick assets. So here the current assets is given. Also, no, the current assets is not given. But the current ratio here given. So if you know the current liabilities, so current liabilities are 29,000, then you can find out current assets. So your current assets is 58,000 because your current ratio is 2 is to 1. From that, you have to minus prepayments and inventories to find out quick assets. So uh, uh, here they only deducted prepayments. Yes, so your prepayments is 7,500. And also you have to deduct the inventories as well. So to find out quick assets, sorry, that's right. From the current assets, you have to minus prepayments and closing inventories. So your quick assets are 29,000. So to find out quick ratio, quick assets divided by current liabilities. So your quick assets is 29,000 we found here. And the current liability is 29,000. So your quick ratio is 1 is to 1. And then debtors collection period. How to find out debtor collection period? So to find out debtor collection period, you have to find out first average debtors. So average debtors opening and closing divided by 2. So your opening debtors is given. Yes, debtors balance as at opening is given here 22,500. And the closing debtor balance given here 17,500. So addition added those two and then divided by 2. So your average debtors is 20,000. So collection period is finding from average debtors divided by sales into 360. So which mean days. So your collection period from debtors, average collection period from debtors is 60 days. Okay. And next one, you have to find out inventory turnover. So to find out inventory turnover, you have to first find out the average inventories. So the opening and closing inventories is given. So addition that and divided by 2. So your average inventories are 20,000. So to find out average inventory turnover, cost of sales divided by average inventories. So your inventory turnover is 4.5 times. And the last one, you have to find out debt to equity ratio. So your closing equity, we have to find out. So your opening equity is given here to 81,000. To that, you have to add the profit. So your closing equity is 90,000. So then debt to equity ratio, loans given here 54,000. So 54,000 divided by 90,000 into 100%. So your debt to equity ratio is 60%. So you have to follow these all workings to find out the each ratios, right? So that's how you are earning 10 marks. So if you give the correct answers, so which means you can earn those 10 marks. But let's think that your answer is incorrect. But if you mention how that you find that answer, and if those workings are correct, the way of workings are correct, you can get the half of marks. Okay. Let's go for 2022 question. So here also given the informations and the additional information, and then they ask to find out these ratios. So gross profit ratio, gross profit divided by sales into 100%. So here the gross profit and the sales given directly, and your gross profit ratio is 35.55. And to find out net profit, you have to get the net profit divided by sales into 100%. So your net profit is 1,350, and that one you have to find here. How to find out the gross net profit? You have to minus operating expenses, interest expenses, and income tax from the gross profit. So your net profit is 1,350 divided by 9,000 into 100%. Your net profit ratio is 15%. And inventory turnover. So how to find inventory turnover? You have to get the cost of sales, and then that cost of sales you have to divide by the average inventories. So here given the sales and gross profit. So the difference of sales and gross profit is your cost of sales, right? So your cost of sales is 5,800, and average inventories here given the inventory as at closing date. and here given the inventory as at opening date. So to find out average inventories, you have to add opening inventories and closing inventories and then divided by 2. So your average inventories are 1000. So your inventory turnover is 5800 divided by 1000, 5.8. And debtors turnover, sales divided by average debtors. So sales given directly 9000 and average debtors, here given the debtors of closing 1400 and here given the debtors as a opening date 1600. To find out average debtors, you have to add opening debtors plus closing debtors divided by 2. So your average debtors are 1500. So the debtors turnover 9000 divided by 1500 6 times. Earnings per share, net profit you have to divide by number of shares. So your net profit we found earlier 1350. Number of shares given here 150,000 directly. So your earnings per share is 9 rupees. And dividends per share. So to find out dividends per share, the interim dividend that you distributed, you have to divide by number of shares. So here the dividends you distributed is 300,000. Is that given directly? No, right? You have to find out how to find. No, no. Here it's given directly 300, and the number of shares is 150. So which means dividend per share is 2 rupees. And the other case, they are asked to compare and state whether the affections comparing to the last year is that favorable or unfavorable to the business. So first one, they asked to compare gross profit ratio. So in 2021, gross profit ratio is 38%. And in 2022, the gross profit ratio is 35.5. So what happened comparing to the last year, the gross profit ratio was reduced. So which means that is an unfavorable situation to the business comparing the last year. And then we have to compare net profit ratio. So the last year net profit ratio is 12.5, but the current year it's 15%. So comparing to the last year, it was increased, right? So that is a favorable situation. Inventory turnover in the last year 6, but in the current year 5.8 reduced, so it is unfavorable. And debtors turnover in the last year 5.5 and in the current year 6. So that was increased, so that is favorable. Earnings per share in the last year 7.5, but in the current year 9, so it's increased, favorable situation. The last one, dividends per share in the last year 2.5, but in the current year 2, so which means that is an unfavorable situation compared to the last year. So that's it for 2022. And the last one, 2023 A levels pass grade. So it's also a big question and a lot of informations. So first one they ask in these ratios, and the second one they ask into comparison. Comparison. So net profit ratio, net profit divided by sales. So net profit is given directly, yes. So net profit here 90, and the sales given 600. So net profit ratio is 15%. And to find out return on equity, net profit divided by equity. So net profit given 90 directly, and the equity is also, yes, equity means stated capital plus reserves. So here reserves only retail banks. So 300 plus 100, your equity is 400. So your return on equity is 22.5. Debt to equity, loans divided by equity. So long-term loans here given 250, and equity we found earlier 400. So your debt to equity ratio is 62.5. And earnings per share, net profit divided by number of shares. So number of shares given here 25 million, and the net profit is 90 million. So 90 divided by 25, your earnings per share is 3.6 rupees. And dividends per share. So here you distributed, is that given directly? The dividends 50. Yes. How to find out that? So here the profit after tax is 90, and here it's given you. Interim dividend you paid 50 million. So 50 divided by 25, dividends per share is 2. And interest coverage ratio, profit plus tax plus interest. Your profit 90, tax 30, interest 20, divided by interest 7 times. So which means you can pay your interest from your profit 7 times. Lastly, they ask in the comparison. So here these information given related to Bima's PLC. So you have to compare these information regarding the last the company that we discussed, Amar PLC. So they are asking the company that generates the higher return on sales. So to find out that, you have to consider net profit ratio. So in Amal PLC's net profit ratio is 15%, and in Bimal's PLC it's 21%. So comparing both that, Bimal PLC generates more return on sales than Amal PLC. And second one, they ask in the higher level of gearing, so which mean the leverage values. So to find out that, you have to compare debt to equity ratio. Concern ratio is debt to equity ratio. So in Amal PLC we found 62.5, and in the Bimal PLC it's given 65%. So comparing that, Bimal PLC have more leverage value. And earnings per share, so which means they are asking that distribute the higher amount of the profit for the shareholders. So to find out that, you have to consider earnings per share. So in Amal PLC we found 3.6 rupees, but in the Bimal PLC it's given 3.75. So which means Bimal PLC distributed higher profit to the shareholders. So that's it for ratios. And from this video I discussed ratios from 2019 to 2023 in past papers. So keep in touch. I will upload the other videos as well, and do share with your friends, and do comments the compliments and also the complaints. Right. So until that, goodbye, Jai.